You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
Hello, I'm Kristen Hallam, content strategist at S&P Global Market Intelligence, and your host for this episode of the Economics and Country Risk podcast. We've seen some positive surprises recently on real GDP and survey data in the eurozone and EU, indicating the economy is more resilient than expected. What's driving those surprises? And what do we see when we look beyond the headline figures? Is there still a risk of recession? Here to answer these burning questions is Ken Watrett, Head of Europe Analysis and Insights at S&P Global Market Intelligence. Ken, let's give our listeners a little history lesson on how we got to where we are. Let's go back about 6 months or so before winter started. What did the economy look like then, and what were the biggest worries for economic ministers at the time?
Well, if we go back to the period before the winter, the biggest worry was that Europe might run into energy shortages, prompting potentially rather severe recessions. And the key reason for that concern was Europe's historical reliance on Russia for large parts of its energy supply, particularly for gas. So the big concern was that if we go into the winter, it's a cold winter and parts of the economy were to run short of energy, then we could end up with some severe output contractions and then the typical kind of spillovers from that, which would be deterioration in labor market conditions, rising unemployment, adding to the headwinds to consumer spending growth from high inflation, more turbulence in financial markets, and so on. I'm glad to say those concerns didn't materialize, but that was the worry just a few months ago.
And what does the picture look like today for the European economy?
Well, it's rather mixed. If we look at the latest GDP figures that are available for the final quarter of last year, the euro area and the EU, for example, they were pretty much flatlining. The good news has been in the sentiment surveys, which are more timely. They suggest a return to growth in the early part of this year, albeit rather subdued growth. And of course, there are variations across the regions. Some economies in emerging Europe are already in recession based on their data for the final quarter of last year. In Western Europe, some economies contracted in the final quarter of 2022, including two of the largest, Germany and Italy. In some of the smaller economies like Greece, recent growth rates have actually been remarkably strong, albeit after a long period of underperformance. So in general, it's rather mixed. Also, if we look beyond just the headline GDP numbers, the composition of growth in most parts of Europe has not been that favorable. What I mean by that is that we've had weakness in private consumption, again related to those inflation headwinds, and also weakness in investment. So domestic demand has actually deteriorated quite a lot. That in turn has led to weakness in imports, and statistically that gives a boost to growth from a net trade perspective. So actually the underlying picture for domestic demand is a bit worse than the headline figures would suggest.
Interesting. Lots to unpack there, lots of moving parts. When we talk about the pockets of resilience that we're seeing in the economy, what factors are contributing to that?
That's a good question. Actually, there's quite a few. They include gas prices having come down substantially. Again, if we think about where we were in the autumn of last year, the TTF price for wholesale gas prices in Europe was in excess of 300 euros per megawatt hour. Currently, it's about 50. Now, compared to the past, that's still rather elevated, but that's been a huge decline over the last few months. And that's again related to those concerns regarding winter shortages having dissipated. At the same time, we've had many governments in Europe delivering fiscal support targeted at mitigating the impact of higher utility prices on household real incomes. There's also been some pent-up demand for services previously hindered by COVID and various containment measures. Think about things like tourism, travel, recreation, and so on. One of the other supportive factors has been a pool of excess household savings which were built up during the pandemic. Again, due to the restrictions on economic activity at the time, savings picked up, and that's provided some cushion as headline inflation has really picked up and household real incomes have been squeezed. By running down that savings cushion, that's limited some of the adverse impact on consumer spending. And also, we've seen relatively encouraging labour market conditions. Employment has remained relatively solid. So far, unemployment rates across most of Europe are at or close to record low levels. And the final factor I would mention, one of many, is rebounding production in some sectors, including auto production, which have been held back by supply chain bottlenecks. And now those bottlenecks are easing. We've seen a marked pickup. I should say overall, the industrial sector has been struggling as some of the energy sensitive sectors like paper production, for example, or chemicals production, they've been really weak. So again, there's a very mixed picture. But overall, that combination of factors have helped to keep Europe out of recession. Just.
That's the key word there. Are some of these factors at play in other developed economies, say the US, for example? Just listening to what you were saying, the strong labor market, for example, we're seeing that in the US as well. Any other common threads to highlight there?
Well, you're absolutely right to highlight there are some common influences, and you've mentioned some of those. I mean, the accumulation of household savings that we saw during the COVID pandemic, that was common across many parts of the world. Also, those supply chain bottlenecks, of course, that's been a common shock to the global economy. They've been easing in Europe, but also elsewhere, including in the US. And labor markets have generally been robust, in fact, too robust for the Federal Reserve, who would like to cool the US labor market down in order to keep wage growth in check and bring inflation back to target. So yes, there are some parallels, but there are also issues which have been particularly important to Europe, and we touched on those already, thinking about potential swings in energy prices and possible supply shortages. They've been a real focal point for Europe, given its historical reliance on energy supply from Russia. And also the fiscal support has been very targeted in Europe, particularly aimed at household utility bills. So again, there has been generally fiscal support in place across the global economy following the pandemic and then following the pickup in inflation that we've seen. But that's been a particularly important help to Europe's economies over the last few months. Now, of course, that is temporary assistance which will be phased out over time. And we need to think about that because these provide some short-term support for economic activity, but public finances in most of Europe are not in great shape. And as we go forward, we're going to have to see some fiscal adjustments, and that's likely to lean down on domestic economic activity.
What kind of time frame are we looking at for those winding down some of those policies that you just mentioned?
I'd separate the timeline into two distinct phases. One to do with the emergency measures that were introduced to try and counteract those increases in energy inflation rates. They're being phased out all the time. Different timelines depending on the country involved, but the maximum amount of fiscal support is already in the past. Then we need to think about the underlying fiscal dynamics across European economies, and that will take a longer period of time to adjust. The Stability and Growth Pact in Europe was suspended when the pandemic struck. That suspension has been extended. But as we move into 2024, then pressure will increase on governments to put their public finances back into better shape. And we know many countries in Europe have very high public sector debt burdens. They're running very large budget deficits still. And so that is going to be a multi-year process. It's one of those longer term factors we think which will be leaning down on European growth beyond just the next few months or quarters.
A minute or two ago, you used the word robust, and that reminded me that we should really clarify for our audience that when we talk about resilience in the economy, resilience is not the same as robust, correct?
Absolutely right. That's a really important distinction. And I think this is, again, one of the areas where the situation in Europe has perhaps been different to other regions and countries. So again, if we go back to the autumn of last year, there was a genuine fear of severe recessions in Europe during the winter for the reasons already explained, particularly centered on energy shortages. Now, in the end, those shortages didn't materialize for a variety of different reasons. Relatively mild weather was very helpful. There have been alternative sources of supply, including LNG, which have been helping. So although the current economic environment is still rather challenging, relative to expectations, Europe's performance has been a positive surprise. But having said that, we need to be careful that we don't get too carried away because, as I was saying, the euro area and the EU in the final quarter of last year, the latest data available, they were effectively flatlining. So they're avoiding recession, but only just. And even the more positive indications that we've had recently from some of the survey data, including our PMIs, have been suggesting very muted rates of growth. So those headwinds to growth are still with us. So yes, we've avoided the worst case scenario, but the economic environment is still far from normal.
Now, all these different metrics and indicators must keep you quite busy, I'm sure. I understand you have a dashboard that you use. Could you maybe talk about that a little bit and give us a brief tour?
Yeah, absolutely. So this is an inflation dashboard for the euro area. And long story short, it contains a wide range of metrics designed to give us a broader picture of underlying trends in inflation. The reason why we do this, there are various reasons, but probably the most important one is that some of these indicators are not publicly available. We calculate them ourselves, and that's aimed at better informing our monetary policy forecasts because we know that central banks are doing the same kind of exercise. So to give you a couple of examples, we calculate a trimmed mean inflation rate for the euro area. That's an alternative to the traditional core measures of inflation, which exclude food and energy. Again, to keep it simple, what we do is we look at how prices have evolved across the full spectrum of data available, and then we remove the top 15% and the bottom 15% of items each month, and then we create an alternative measure of inflation. We also look at various other things, including the number of those items in the consumer price index which have inflation rates above the ECB's 2% target. And we also create some inflation rates which are based on a smaller subset of items. We call one of those the supercore inflation rate, where we only take the items which we deem to be sensitive to the output gap in the euro area to give us a sense of whether this is more domestically driven price pressure or whether it's something more global, more common amongst economies inside and outside of Europe. The aim of doing this is to better understand what's driving inflation, how it may evolve, and also to better understand the outlook for monetary policy, given the importance of that, of course, for economic and financial prospects.
So looking at the inflation dashboard at present, are there any lights flashing on the dashboard right now?
Unfortunately, there are plenty of them still flashing, and not in a good way. Those alternative metrics that we track most closely, like the trim mean rate, the supercore rate, the proportion of items with inflation rates above the 2% goal, they all hit new record highs in January, which are the latest figures we have available at this point. And that's one of the reasons why I was suggesting not to get too carried away with the positive growth surprises in Europe relative to the expectation from last year that we could be headed for a severe recession. That recession during the winter may have just been avoided, but with inflation so high and with underlying inflation pressures looking pretty alarming right now, there is a risk of a policy-induced recession further down the line. That wasn't the focal point initially. It was centered on energy, but now with inflation proving quite stubborn and core measures still accelerating, the worry would be that central banks have to keep on extending their policy tightening, and that could tip economies in Europe into recessions a bit further on.
You also mentioned the surveys earlier. Can you tell us a bit more about that? What is it about the PMIs that make them so useful?
There are various different attributes of the survey data and the PMIs in particular that we find useful, but I'd focus on two in particular. First, it's the timeliness. So to illustrate the point, we receive the flash PMI data before the end of the calendar month. So we can effectively gauge what's happening in the economy in real time. One of the challenges in looking at some of the European economies, and certainly looking at the aggregates like the euro area or the EU, is that the data are released with a relatively long lag. We have to wait for a long time to get the GDP figures, even longer to get the expenditure breakdowns, and even the higher frequency releases, monthly retail sales, industrial production, trade data, the lags are quite long. So the PMIs are really important to give us a sense of where we are in real time, as I said. The second aspect is the breadth of areas or indicators that they cover. So if I think about some of the things we've talked about already that are highlighted as being critical to our assessment of the economic outlook, things like supply chain developments, labor market conditions, trends in prices, and so on. The PMIs cover all of these areas and much more. They're far more than just a gauge of the growth rate in the economy. They give us a lot of detail in terms of what's happening across a wide range of different areas. And we also have a sectoral breakdown in the PMI releases, which again allow us to get a clearer picture of which parts of the economy are underperforming or outperforming. So this information is really valuable.
You've touched on quite a few things that could go wrong for the economy. What do you see as the biggest risks in the eurozone and the EU at the moment to the economy? Is it inflation? Is it something else, a combination of factors?
Well, I think if I was to pick out one primary risk, that would be the one I already mentioned, that underlying inflation proves to be rather sticky and monetary policy tightening is extended. But that's not the only one. There's various other things that we need to think about. One would be an escalation of the conflict in Ukraine and its various spillovers. We also need to keep a close eye on possible recessionary conditions outside of Europe. European economies in general are very trade sensitive. They're very open. Export shares in GDP are quite high. And so if we see a deterioration in demand conditions in the US, say, engineered potentially by the Fed, obviously that can have a negative spillover effect, and not just through trade, also through other transmission channels like confidence effects, more turbulent financial markets, movements in the exchange rate, and so on. And then there are a few other things that we also need to monitor as well. Think about adjustments in housing markets. For example, we have prices for housing already falling quite sharply in many parts of Europe. And that's even before interest rates reach their peak. And typically the policy tightenings that are currently in train only impact fully with a lag. So without having to really think too hard, there's quite a few downside risks out there that we need to monitor. Now, in our base case, these don't all materialize. We actually assume we'll see a gradual recovery in economic activity as we progress through the next few quarters. But we certainly need to be cognizant of some of these downside risks and headwinds.
Absolutely. And that brings us to our next question, which is, what are your top takeaways for businesses? For example, if I'm in the C-suite at a major corporation, what should I be thinking about? What does all this mean for me? Do you have one or two takeaways for our listeners?
I think the main takeaway would be that the outlook is still rather uncertain. I mean, I've flagged various headwinds to growth, some of which could well be rather persistent, and multiple downside risks that we need to keep an eye on. And that uncertainty is unlikely to disappear anytime soon, because a lot of the issues that are driving it are quite persistent. Think about the conflict in Ukraine, or worries about inflation and policy responses, and so on. Now, having said that, the other thing I would stress is it's not all bad news. There are some brighter spots here or there, and one of those is the easing of supply chain bottlenecks and the recent pickup that we've seen in the PMI data for orders and output related to that, and particularly driven by improving conditions in Asia. In terms of one issue above all else to focus on going forward, I'd say it's the importance of inflation continuing to come down. Because if our base case is correct and inflation continues to moderate this year and into next year, the squeeze on household real incomes and consumer spending will ease. That will give some support to growth. And at the same time, we'll see central banks curtailing their tightening cycles and shifting towards looser policy. Now, we're not expecting that until later this year and into 2024. But again, that would be a support for growth. Now, if we're wrong and inflation remains stubbornly high and worries about second round effects on pay growth and inflation expectations continue, clearly we're going to have a more problematic outlook for economic growth. And we're probably going to get more of the kind of financial turbulence we've experienced in recent days with the failure of SVB. One of the things that we know is that when interest rates have moved from a long period of being very low and relatively stable to a period of persistent increases, then there will be some casualties. And one of the risks of that is increased financial sector volatility.
Somewhat sobering note to go out on. Thanks, Ken, so much for sharing your insights with us today. And for our listeners, please Subscribe to the podcast and join us next week as we delve deeper into the economic and geopolitical forces at work in 2023.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter, and don't forget to subscribe to the podcast so you never miss an episode.